Hi, I'm David Bodemer, the Editorial Director with National Real Estate Investor here in San Diego at the Mortgage Bankers Association Commercial Real Estate Finance Conference. Here with David Durning from Prudential. Thank you for joining us.
Good to be here.
So what's going on? How's the show going for you?
Well, 2012 was a busy year, and 2013 is going to be even busier. It's lots of people to meet with, sort of got expansions of our existing programs, and really things are running on all cylinders.
And so when you talk about those programs, what are the priorities? Like I know you've got a humongous real estate platform, so how is that kind of shaping out right now?
Sure. So key elements for this year will be expanding our portfolio lending program to overall $13 billion in originations. We're looking up to 12.2, which is really about our biggest year ever.
Right.
Looking at $8 billion of portfolio lending, about $3.5 billion of agency lending between our Fannie, FHA, and Freddie Mac programs. International production of $1 billion. Mm-hmm. So really looking to expand our operation of loans in Europe out of our new UK office that we opened this time last year. And then we have a new program that we're going to be rolling out called Expanded Agency Gateway, which is a program about $200–300 million of loans that are not quite ready for agency financing and may have a modest rehab component, and that's something we'll be rolling out really in the next month or so.
Okay. And how does it break down by property type? Are you pretty even in all the majors?
We are. So we do more multifamily than anything else because of our agency business. But no, we will. Our overall on-book portfolio is pretty evenly balanced. About 20% office, 20% retail, 20% multifamily, 23% of industrial, which is unusual for a life insurance company, and then we about 5% hotels. So we'll really do a bit of everything.
So the life insurance sector as a lender class is pretty much at its all-time highs right now, right? And so where is the growth coming from in terms, because I mean everybody is saying, okay, we had 2011 was a good year, 2012 was a big year, now we want to grow it even further, 2013. So where does that growth come from, and do you have to change the kinds of conditions you're putting on the loans, or how exactly do you get to that growth?
So two things. First, I want to talk about what's driving the growth, at least in our case. So there's really two key factors going on. One is the relative value of mortgages versus other fixed income instruments in sort of the current low yield environment. That's been a big driver.
Right.
The other big driver has been one that's really more unique to Prudential. Prudential's been involved in some very large pension risk transfers as a product, which is basically had the net effect of increasing our general account significantly, and through that our appetite for mortgages. So that's the first thing. Last year, we probably, the quality of the real estate we financed last year was probably better than any time in my career. I think going forward, what we have to do is we're going to do larger deals. We're going to have to be more decisive. We're going to move into Europe, as I mentioned earlier, to take advantage of really a lack of credit opportunities there. We're going to be doing a bit more unstabilized, pre-stabilized. Last year we did about $400 million of construction pre-stabilized multifamily transactions. We'd look to repeat that again. So we have to do more in more places, and we have to find risks that we like, which basically means working with sort of the better sponsors, keeping our basis down in terms of the leverage that we loan the property down, but living with a bit more risk in terms of lease up or other complexities in the structure.
Right. Okay. So a little bit more risk tolerance, but nothing that's like going to dramatically alter kind of like what the bread and butter.
I think a little bit more risk tolerance. So a couple things, right? So the portfolios are really in strong shape. All of the legacy issues are largely behind us now, so there is more of an appetite for risk out there. But what's better is that we are looking at a slowly improving economy, and the fundamentals will finally move up. So last year, people were loaning more money based on a change in cap rates compression, but cap rates don't pay your loan back, cash flows do. And so as jobs are created and fundamentals improve, that's where we can take some comfort in that over time.
Are there any kind of external things like macroeconomic considerations or regulatory concerns that you have for going forward?
The regulatory process is something that we're watching closely. It impacts our CMBS business. It impacts how we are regulated as a large financial institution. I would say it impacts our agency business. What's the ultimate outcome with the GSEs?
Right.
I think we don't, other than saying we're watching, it's really inconclusive right now what those changes will mean. But in terms of our internal initiatives, it's one of our top 10 initiatives, is be prepared for whatever comes next, because it could have a big impact, obviously, in what we're doing in our business.
Great. All right, well, I want to thank you so much for taking some time to spend with us.
Pleasure.
So this is David Durning from Prudential, and continue to watch our coverage of the MBA show.
Thank you.